Hey everyone, welcome back. Today we're diving into one of the most important arrays that I use, fair value gaps. This one concept explains why price reverses out of nowhere, where smart entries are hiding, and how the algorithm actually delivers price. You can find it everywhere. If you're not using fair value gaps yet, you're missing some of the cleanest setups in the market. Let's break it down together step by step live on the chart. Let's get into it. Fair value gaps are imbalances in price. They happen when price moves too quickly in one direction, leaving a void. Think of it like this. Price surged, but didn't give the market time to fill in orders fairly. That's where inefficiency shows up. And because the algorithm is programmed to seek efficiency, price usually comes back to rebalance that area. That return into the imbalance, that is your opportunity to get in. Here's how to find a fair value gap. You look for 3 candles. Candle 1, candle 2, the impulse, and candle 3. If candle 3 doesn't wake back into candle 1, there is a gap between them. That is your fair value gap. In bullish setups, you'll see a bullish candle, then a big impulsive candle, and then another bullish candle. The space between the high of the first candle and the low of the third is your gap. In bearish setups, it's just the other way around. Once you've trained your eye, they become obvious. The bullish gaps are called BISI, or buy-side imbalance, sell-side inefficiency. The bearish gaps are called SIBI, sell-side imbalance, buy-side inefficiency. So why do fair value gaps matter? Because price wants to come back to them. Markets aim for efficiency, and imbalances act like a magnet. That magnet effect is what gives you structure and timing for entries. But don't enter just because you see a gap. You want to see confirmation. Let's go through an example. This was the Euro USD trade I gave to my members, and it is based on fair value gaps. Let me show you how I got it right. Price runs above a high, then it drops into a fair value gap. We are bullish on the higher time frame as well. Once price gets into the fair value gap, that is not your signal to buy yet. You wait for price to take liquidity and for time to align. Right here is at 9 p.m. You ignore that as well. 1 a.m. is the London session. We ignore this candle as well. And the time we are talking about here is a New York kill zone. So let's drop to a lower time frame. In the 15-minute time frame, you want to see a structure break above. Price took liquidity right here and broke structure. This is our liquidity raid, and this is the market structure break. As you can see, we have a beautiful fair value gap formed right here. This is your high probability fair value gap. Once you see this, you've got your entry. Your stop loss goes below the fair value gap candle or below the swing low. Watch how price gets into it once again, and then moves higher, targeting liquidity right here. Now, these are the 2 arrays I use. Fair value gaps, which represent internal liquidity, and highs and lows, which represents external liquidity. Understanding this helps you frame your trades. First, price seeks external liquidity, like equal highs or equal lows, and once that liquidity is taken, price usually retraces into internal liquidity, which is your fair value gap. I'll go into more detail on this topic in a further video. There are 3 levels to a fair value gap. You have the institutional order flow entry drill, the 50% or consequent encroachment, or the fair value gap filled. These are in order to how aggressively price will react. If price returns into the fair value gap and does not tap the 50% level and moves higher, this price will be the most aggressive run towards liquidity. Most of the moves, especially the ones outside the kill zone, tap the 50% level. If price fills the gap then it's going for an order block right below it. Check out my previous module to learn more about order blocks. Now, not every fair value gap is worth trading. So how do you filter out the weak ones? First, consider the time of day. Focus on fair value gaps that form during London or New York session. These are created with algorithmic intent. Asian session gaps are usually weak and less reliable. Second, align with your high time frame bias. If the 1 hour and the 4 hour is bearish, you want to look for bearish fair value gaps, not bullish ones. Third, look for confluence. Is the fair value gap sitting inside a higher time frame order block? Did the fair value gap form after a liquidity sweep? Is the structure shifting on the time frame you're trading on? That's when you know you're trading something real. So here's a quick recap. Fair value gaps are price inefficiencies created by aggressive moves. They get filled as the market seeks balance. They act as liquidity and serve as powerful entry triggers. And when you combine them with structure, liquidity, and time, you get high probability institutional setups. So start marking them, study how price reacts, see which ones get respected and which one gets ignored. If this helped you, drop a like, comment fair value gaps below, and I'll see you in the next one.